Welcome to the market analysis for July 2017. My name is Barney Hawkins and I'm Investment Director at True Potential. I'd like to look at how the markets have performed over the last month and also examine some of the key themes affecting our fund managers at the moment. In the UK, the indecisive election result and Conservative Party manoeuvrings to form an alliance with Ireland's DUP have played on investors' minds. Speculation that the government's slender majority could herald a softer Brexit helped cushion sterling weakness, but the general election has undoubtedly prompted questions around the strength of the UK economy. That said, company fundamentals continue to be positive, and the weak pound has helped exporting companies to remain competitive internationally. Looking at performance, the UK stock market suffered no immediate reaction as a result of the election outcome. This partly reflects the fact that the UK market is already unpopular with overseas investors, and so there was no negative lurch downwards as so-called hot money was withdrawn from the market. However, over the second half of the month, UK equities did pull back a touch, losing 2.5% after delivering impressive returns of over 4% in the previous month and 4.7% year to date. In marked contrast with the UK, Europe has become more politically stable, with the election of Emmanuel Macron as the new French president. His obvious support for an integrated Europe has improved confidence across the Franco-German nexus, and with the ECB continuing its program of low interest rates and quantitative easing, consumer confidence is high. For European businesses, this provides a welcome backdrop against which to invest and grow their operations with a degree of certainty and confidence. European stock market returns have been excellent in both local and sterling terms so far this year, but the past month has witnessed something of a pause for breath. Returns were down 2.1% in local terms, although the strength of the euro pared back the loss to 1.5% for UK investors. The region continues to be well supported by our managers, who cite abating political risk, solid company earnings figures, and relatively attractive valuations. In the US, the key event last month was the decision by the Federal Reserve to raise interest rates by 0.25%. The Fed also announced that later this year it would begin to reverse the process of quantitative easing, effectively selling back into the market the $4.5 trillion worth of Treasury stocks and corporate bonds it has been buying for the last 9 years. Although this announcement does represent a watershed in the recovery of the US economy since the 2008 financial crisis, the markets had been anticipating such a move at some stage, and reaction to the announcement was relatively muted. Of more importance to the day-to-day movement of the market is the tech sector, where investors have been taking profits following a very good run this year. Over the month, US equities were up 0.8% in local currency terms, the weakness of the dollar pulling this back to a slight fall of 0.2% when converted to sterling. The best performing market this year has been Asia-Pacific based equities, and last month was also strong, with the region returning 1.9% in local terms and 1% in sterling terms. The region's economic backdrop is encouraging, and while there are concerns about a growing credit bubble in China, the outlook for economic growth and corporate earnings remains positive.